We've got an earnings alert on SoFi. Shares are surging 7% after its quarterly report card. Kate Rooney is back with the details. Kate.
Hey, Melissa. Yeah, SoFi with better than expected numbers and some upbeat guidance. Adjusted net revenue was up 50% year over year. It also saw record member growth and upped full year EPS and revenue guidance. I caught up with SoFi CEO Anthony Noto about the quarter and the macro environment. He says, yes, we are absolutely in a technical recession. We expect to be in a pretty limited growth environment for the foreseeable future. But he also talked about diversifying revenue for SoFi. He says, quote, we continue to take share from existing banks, leverage the breadth of our products to drive consistent growth, and talked about very few companies having a lending business, tech platform, all of those financial services products like checking, savings, credit card, investing, and brokerage, as well as insurance. But he says there is without a doubt a challenging macro environment right now. Noto also mentioned a shift away from that student loan business. It used to bring in about $2 billion in originations. Right now, it's only operating at roughly 25% capacity after the student loan moratorium. No expectation, he says, for that to rebound until 2023. He also says they haven't seen a jump in delinquencies for SoFi. It's around 2019 levels right now in terms of delinquencies and net charge-offs. He says SoFi, though, tends to skew towards higher credit quality. But the stock up more than 7% here after hours. Melissa, back to you.
All right, Kate. Thanks, Kate Rooney. The stock was down 60% year to date going into these earnings.
80% in total.
Yeah.
From its high.
So you very much caught it up in the fintech revaluation. So the stock was down a lot. I think one of the things making the stock pop today, besides the earnings outlook for the second half being decent, the adjusted EBITDA being decent, I understand home loans are down. That makes sense. And student loans being down. It's, I think, partially the almost 20% short interest. So if this wasn't a quarter that was going to be really bad, then I think the story of the short might be over now.
Yeah, I think it's a combination of also just if you look at where the stock has come from and you now look at on valuation in a world where we look at these valuations differently and we understand some of the credit dynamics, but where there's actually growth, they just got to do about $1.5 billion on adjusted net revenue by the end of the year. So that's 4 times sales. That's hardly expensive in the context of, again, where they're coming from, which I know is something you're pushing back on tonight, Melissa. We're not allowed to do that anymore. So.
I'm just raising
no,
the
it's
question.
Good question.
You know, should we have ever been there?
Exactly. We shouldn't have.
Anyway, let's move on here. Credit card debt seeing its biggest jump in more than 2 decades. Balances surging 13% in the second quarter as higher prices outweigh wage growth. Plus, the latest monthly JOLTS report showing job openings dropped to the lowest level since last September. For more on all this, let's bring in Mark Zandi, chief economist at Moody's Analytics. Mark, it seems like it would be bad news on the surface, but you actually say this is good news for the consumer.
Well, I took a lot of solace in it, Melissa. I mean, bank card debt is up, yeah, but it's still well below what it was pre-pandemic. Consumers are paying back their debt at a very high rate. And bottom line, delinquency rates are very low. I mean, we get data on all the credit files in the country from Credit Bureau Equifax every month, and I've got data through July. And the July delinquency rate is 2.35%. You go back pre-pandemic, which was a pretty good time, it was well over 3%. So, you know, I don't really see anything in there to be concerned about. You know, looking across all of household debt, the one thing that gives me a little bit of pause is you see a big increase in consumer finance borrowing, and these are lower quality borrowers and you know, fintech companies, that kind of thing. But in the grand scheme of things, it's not a lot of dollars, so it's not a big macro event. It's, you know, it's a relatively minor. So no, I don't really see anything in this data to be concerned about, at least from looking at it through the prism of what it means for the consumer and the economy.
Hey, it's Courtney here. Just a quick question for you. I think it's really great to see that delinquencies are low right now, and it's actually a lot of, I think you're saying, positive data, things we don't necessarily have to worry about. But I guess the question is, how much of that is backward looking here, right? If we are seeing inflation is starting to pinch the consumer, half of companies right now are saying that they're starting to see people trading down for their items, and now we're starting to see they're putting more on credit cards. How much of that do you think is backwards looking versus what we need to look at in the future, if that makes sense? Well,
I don't know. I mean, in the future, it looks like inflation's going lower, right? I mean, gas prices are way in. We were at $5 a gallon, record high back in mid-June. We're now at $4.30 and falling. It feels like food prices have peaked. You look at ag commodity prices are coming in. So inflation is very high, don't get me wrong, and it's very painful and it's cutting into consumer purchasing power. But they're holding up pretty well, and I think inflation is starting to recede. And here's the other thing. They've got a boatload of excess saving. During the pandemic, particularly high-income households, they sheltered in place. They saved a lot more than they typically would. And low-income households got a lot of government support. And so they have that cash cushion. And, I think that cushion is tiding them over. They're starting to burn through it. And you're starting to see, some lower income households in particular are starting to struggle with this. But broadly speaking, I think the consumer's holding in pretty well.
Mark, it's Karen. Thanks for being on. So let me ask you, these higher balances with this very good credit quality, what do you think this means for banks who have, it's such a high margin item for them?
Well, it sounds good to me, right? I mean, I think they're only worried. A lot of credit card revolving. The card people are using their cards. Delinquency rates are low. That all feels pretty good. I think the thing that makes them uncomfortable is the high repayment rate. They're revolving the card, right? They're using the card to buy stuff. And by the way, that's the reason why card balances are up a lot, because people are buying lots of stuff that use cards. Like if you go out and travel, you got an airplane ticket or a hotel room, and everyone's out doing that, they're going to use their card. But they're not holding on to it. It's not debt, so they're not collecting interest payments on it. So, I think if looking at it from the prism of a bank, they'd like to see borrowers actually use that card as a debt vehicle, and so far they're not doing that.
Isn't seeing the consumer so resilient, Mark, though, sort of bad news in that it tells you that the Fed has a lot more wood to chop in terms of slowing demand down in the economy to slow things down enough to bring inflation down to the levels that they want to see?
Well, Melissa, you're looking for bad news. I'm not going to give it to you.
I'm just raising the other side of it. I mean,
no, that's fair. That's fair. But look, there's a lot of the economy's got other problems. I mean, the housing market is definitely taking it on the chin. We got very significant drag from the trade deficit and balance. So growth is definitely slowing, and growth will continue to slow. And I'm not saying the consumer is out spending with abandon. They're doing just their part, which is critical to make sure that the economy doesn't go into recession. So in my mind, the American consumer is the firewall between an economy that avoids recession and one that goes into a downturn. The firewall is under pressure because of the high inflation, but it feels like it's holding firm, and the fire is now starting to recede. And if that continues to be the case, we got a fighting chance to make our way through without going into recession.
All right. Mark, Zandi, thank you. Always good to speak with you.
Thank you.
Jeff Mills, this is the notion of the soft landing, isn't it?
Yeah, it is. But Mel, I think you make a really good point about the Fed, right? And you had this perceived pivot, but then all of a sudden, basically right after the press conference, you saw long-term inflation expectations jump by a pretty significant amount. So basically what the market is saying, it's way too early for the Fed to pivot. We talked about that, and I do think that that's generally problematic. And I think the reality is, and Courtney mentioned this, we have to look forward relative to the consumer. We always talk about monetary policy impacting the economy with long and variable lead time. So I think, we're only just seeing the effects of higher interest rates on the consumer. And you listen to companies, they're saying the consumer's okay, but I think if you read through some of the data, you start to see the early signs of it. And that's what I'm looking at. AT&T talking about later payments from their customers. Visa saying there's no weakness, but, that could be lower quantities at higher prices. Similar for P&G. So, if you read through some of the commentary, I think it's the early signs of the consumer starting to slow down, and that's what worries me the most.
Input costs may be coming down, but these price increases that the consumer are feeling, they're sticky. Rents are sticky. That's going to be some time, Tim, before the consumer feels relief on that front.
I agree. And I think the housing market is also another place where the Fed needs to target. They actually want there to be more pain in the housing market. I just go back to what we had a conversation yesterday about regional banks. Their lending and their ability to actually make profits from this higher interest rate environment is, I think, extraordinary. What Mark had pointed out in some of his notes is that he's actually seeing some tightening in lending standards.
Yep.
That, to me, is disappointing after years of headwinds here, that actually banks are starting to lend again. Let's see how that goes.